Most people don't actually want investment returns. They want bills covered. They want fewer money decisions. Josh is invested, but his money still doesn't feel like it's doing that. So he asks a practical question. If he invests $500,000 into a dividend portfolio, what can that income realistically cover? What do the payments look like month by month once they start showing up? Groceries, utilities, insurance, maybe part of rent, without selling a single share. In this video, we walk through the entire setup from start to finish. You'll see how Josh builds the portfolio, how the stocks are chosen, how the income is scheduled across the year, and what those dividend payments actually look like when they hit the account. And in the end, I'll show you how, over the long run, this same portfolio grows into something much bigger, reaching a valuation of over $18 million and paying Josh more than $60 grand per month in dividend income. To understand why this works at all, you first have to understand the mindset behind it, and that starts before a single stock is ever bought. Josh isn't looking for fast income or short-term wins. What he wants is structure, something that runs without constant decisions. Instead of asking how quickly the portfolio might grow, he focuses on whether it can support real life in a steady, predictable way. For that, Josh chose dividend stocks for his $500,000. That shift changes how investing feels. Dividends make ownership tangible. They represent real businesses sharing a portion of their earnings with shareholders. When those companies perform well, part of that success is paid out as cash on a predictable schedule, creating income that can be planned around rather than guessed at. Reinvestment strengthens the strategy. Each dividend payment is automatically used to purchase additional shares. Early on, the changes are small and easy to overlook. Over time, those added shares begin generating dividends of their own, which are reinvested again. Income stops growing in a straight line and starts building on itself. The process doesn't rely on reacting to market movements or finding the perfect moment to act. It relies on consistency and time. This structure removes much of the pressure that often comes with investing. There is no need to monitor daily price changes or react to headlines. Dividends continue to arrive across different market conditions, and reinvestment continues without interruption. The system keeps working as long as it's left alone. This mindset creates stability. Focus shifts away from short-term outcomes and toward building a durable framework that can perform over decades. With that foundation in place, the focus shifts to execution. Results aren't built through constant moves. They come from sticking to a system and letting it work over time. That's why stock selection here isn't about excitement. It's about dependability. Every company in the portfolio has to support steady income first. Growth still matters, but only after reliability is established. Stability is the first filter. The focus stays on businesses that have been operating for a long time and earning consistently. Companies that have already made it through recessions, rate changes, and market stress have shown they can keep generating profits even when conditions aren't ideal. That history matters far more than fast growth or short-term momentum. Dividend history is the next filter. It is not enough for a company to pay a dividend occasionally. Consistency matters. A long record of uninterrupted payouts signals discipline and financial strength. In many cases, those dividends increase over time, allowing income to grow naturally without adding new capital. Payout ratios also matter. This measures how much of a company's profits are paid out as dividends. When that number is too high, the dividend becomes fragile. By keeping payout levels reasonable, usually below 70%, income remains supported by real earnings rather than hope. Diversification plays a key role in keeping income steady. Instead of relying on one type of business, exposure is spread across healthcare, consumer goods, utilities, industrials, real estate, and a dividend-focused ETF. If one sector slows down, another can help offset it. Timing is the real consideration. Some companies pay quarterly, others monthly. The goal is not to make every month look the same, but to understand the schedule so the income pattern makes sense. With the selection rules in place, the next step was structure. Josh wants a portfolio that's easy to understand and easy to live with. The goal isn't complexity or squeezing out small optimizations. It's keeping it simple, something that could be understood, managed with minimal effort, and trusted to behave predictably over time. The full $500,000 is split evenly across 10 positions. Each one gets 50 grand. This equal weight setup removes the need to constantly rebalance or second-guess decisions. Every holding pulls its weight, and no single decision takes over the results. To keep things organized, Josh grouped the holdings into clear categories, each with a specific role. The ETF category provides instant diversification. Instead of relying on individual companies alone, This portion spreads risk across dozens of high-quality dividend payers. It acts as a stabilizing core when individual stocks move in different directions. Blue-chip dividend stocks form the backbone of the portfolio. These are established businesses with dependable earnings and long histories of paying shareholders. Their operations don't change much, and their consistency helps anchor income across different market environments. Dividend aristocrats and kings add another layer of reliability. These are companies that have raised dividends for more than 25 and 50 years respectively. That history doesn't guarantee future results, but it does show commitment. It also creates a natural path for income growth without adding new money. The REIT category focuses on income. Real estate investment trusts are required to distribute most of what they earn, which supports higher payouts. Including a monthly payer helps smooth the gaps between quarterly dividends and makes cash flow feel more consistent throughout the year. Finally, growth-oriented dividend stocks round out the structure. These positions may pay less today, but they offer room for rising dividends over time. They support the long-term side of the portfolio without sacrificing current income. By spreading the $500,000 evenly across these roles, Josh ends up with a portfolio that balances income, stability, and growth. Just as important, it stays simple enough to manage without constant adjustment, which is exactly what allows the system to keep working as intended. Even with a solid structure, there are a few mistakes that weaken dividend portfolios over time. They're easy to overlook because nothing breaks immediately, but the long-term impact can be significant. One of the biggest mistakes is chasing high yields. A dividend that looks unusually large, often in double digits, comes with risk attached. Sometimes the business is struggling, other times the payout isn't supported by earnings. When a company is forced to cut its dividend, income disappears at the exact moment it was supposed to feel reliable. A sustainable yield supported by real profits is far more valuable than an eye-catching number. Another common mistake is expecting every stock to pay monthly. Most dividend-paying companies distribute income quarterly, and that's normal. Problems arise when expectations don't match reality. If you don't understand payout schedules, some months can feel disappointing, even when the portfolio is performing exactly as it should. That's why mixing payment schedules matters more than forcing uniformity. Concentration creates another issue. When too much money is tied to one sector, income becomes fragile. If that area struggles, dividends across the portfolio slow at the same time. Spreading investment across healthcare, consumer goods, utilities, industrials, real estate, and a dividend-focused ETF helps keep cash flow steadier. Taking dividends as cash too early is also a mistake. During the building phase, reinvestment is what drives future income growth. Pulling income out too soon slows compounding and delays the point where dividends become meaningful. The last mistake is judging progress too quickly. Dividend portfolios aren't built to impress early. They're built to grow over time. Avoiding these mistakes keeps the system intact and lets the structure do the work it's meant to do. With the structure set, the focus turns to the companies inside the portfolio and the role each category plays in supporting income. Every position exists for a reason, and each category contributes to the overall balance in a different way. Next, I will show you Josh's stocks for each category in this portfolio, and in the end, I'll show you how, over the long run, this same portfolio grows into something much bigger, reaching a valuation of over $18 million and paying Josh more than $60 grand per month in dividend income. But first, let's look at the stock in each category, starting with the ETF category, which provides the portfolio's foundation. This role is filled by the Schwab US Dividend Equity ETF, which carries a 3.82% yield. Instead of relying on a single company, this position spreads income across dozens of high-quality dividend payers. It acts as a stabilizer, helping smooth volatility and reinforce consistency when individual stocks move in different directions. The blue-chip dividend stock category focuses on dependable income from well-established businesses. PepsiCo sits in this group with a 3.96% yield, offering exposure to everyday consumer products with steady demand. AbbVie also belongs here, carrying a 3.03% yield and providing healthcare stability. These companies operate in essential areas of the economy, which support reliable earnings and dependable dividends across different market conditions. The Dividend Kings and Aristocrats category adds another layer of reliability. Lowe's, with a 1.99% yield, plays a long-term role focused on dividend growth rather than high income today. Black Hills Corporation contributes a 3.9% yield, while Consolidated Edison adds 3.42%, both providing utility-style stability. Nexstar Media Group brings higher quarterly income with a 3.66% yield, and Federal Agricultural Mortgage Corporation contributes 3.42%, adding niche financial diversification. Together, these companies share a long history of consistent dividend payments, supporting income growth over time. The REIT category focuses on cash flow. Realty Income fills this role with a 5.75% yield and a monthly payout schedule. Because real estate investment trusts are required to distribute most of what they earn, this position helps smooth income between quarterly dividend payments and makes cash flow feel more consistent throughout the year. Finally, the growth-oriented dividend stock category supports long-term income expansion. Air Products and Chemicals fits here with a 2.9% yield. Its business relies on long-term contracts and predictable demand, allowing dividends to grow steadily over time without introducing excessive risk. By organizing the portfolio this way, income is diversified across categories, schedules, and business models. Each group plays a clear role, and together they create a balanced system designed to deliver reliable income today while supporting growth over the long term. Dividend income doesn't show in equal slices, and that's intentional. Instead of forcing every month to look the same, this portfolio is designed around understanding when income shows up and how it stacks across the year. Once the schedule is clear, the pattern becomes predictable. The first payout cycle hits in January, April, July, and October. These months are built around a steady base of quarterly payers. AbbVie contributes $379, Air Products and Chemicals adds $363, and Lowe's brings in $249. On top of that, Realty Income delivers its $240 monthly payment, which shows up every single month without exception. Together, these months create a dependable baseline. They aren't the biggest months, but they're easy to plan around. The next group lands in February, May, August, and November. Black Hills Corporation pays $488, Nexstar Media Group adds $458, and Consolidated Edison contributes $428. Realty Income again adds its $240 monthly dividend, anchoring the month. Utilities and media step in here, helping keep income steady even when other companies aren't paying. The final cycle comes in March, June, September, and December, and these are the strongest income months. PepsiCo delivers $495, Federal Agricultural Mortgage Corporation adds $428, and SCHD contributes $478. Realty Income again adds its $240, tying everything together. These months tend to feel heavier because consumer staples and the dividend ETF stack on top of the monthly base. When you zoom out, the numbers get simple. In the first year, the portfolio generates $17,925, which works out to about $1,494 per month on average. For Josh, that income isn't about replacing his paycheck overnight. It covers real expenses. Utilities, groceries, insurance, subscriptions, or part of rent can be handled without dipping into earned income. And when the dividends are reinvested, it happens automatically, without decisions or timing stress. $1,494 per month can feel underwhelming for a $500,000 portfolio. That reaction is normal. This portfolio isn't designed to impress early, it's designed to hold up. The focus isn't pushing income as high as possible in year one, it's on building income that can grow on its own. What matters isn't just the $17,925 in year one. It's what happens when every dividend is reinvested. Each payment buys more shares, those shares produce more dividends. Over time, the income starts building on itself. To see where that leads, we need to look ahead. Not a few months, but years. What does this portfolio look like for Josh 10 years from now? 20? 30? For this, you need to calculate the portfolio's overall dividend yield, because this tells you what the portfolio pays on average based on the yields of the stocks inside it. Since each position is equal in size, this becomes straightforward. You take the dividend yield of each stock and add them together. Then you divide that total by the number of holdings in the portfolio. With 10 stocks, you're simply averaging the 10 yields. When you do that with Josh's portfolio, the result is an average dividend yield of 3.59%. That number gives you a clean snapshot of what the portfolio is designed to produce today, before growth and reinvestment come into play. You can use this same simple averaging method to estimate other portfolio-level metrics as well. Using the 10-year dividend growth rates of each stock, the portfolio averages out to a 9.57% dividend growth rate. And using historical share price appreciation, the portfolio averages to about 8.9% per year. Those three numbers together explain why the long-term projections look the way they do. and they set the stage for what happens when time and reinvestment are allowed to do their work. Based on these metrics, here's what the long-term projections for this portfolio show. Dividend income starts around 18 grand in year 1, just like we saw earlier. Nothing dramatic yet, and that's expected. By year 10, annual dividend income is projected to reach about $55,000, or roughly $4,600 per month. At this stage, reinvested dividends begin to make a noticeable difference. The portfolio is large enough that each new payment meaningfully adds to future income. By year 20, income is projected to climb to approximately $198,000 per year, which comes out to about $16,500 per month. The most dramatic change shows up in the final decade. Between years 20 and 30, compounding takes over. Dividend income is projected to rise sharply, reaching around $724,000 per year by year 30, or about 60 grand per month. Most of the income growth happens here, not at the beginning. This is where time does the heavy lifting. But dividends aren't the only thing growing over time. The value of the portfolio itself is projected to grow as well. In the early years, the change is gradual. By year 1, the portfolio value is projected to reach about $562,000. By year 10, it's projected to grow to roughly $1.63 million. At this stage, growth is steady and reinvested dividends are starting to play a noticeable role. Between years 10 and 20, the pace picks up. As the portfolio becomes larger, reinvested dividends contribute more meaningfully to growth. By year 20, the portfolio is projected to reach around $5.48 million. The final decade is where compounding takes over. Growth accelerates as both the portfolio size and reinvested income work together. By year 30, the portfolio is projected to reach nearly $18.82 million. Taken together, this is what time and consistency create. Income grows, value grows, and most of the results show up later, not at the beginning. This is exactly why patience matters in a system like this. If you could only invest in one index fund, just one, that has the potential to turn $10 into a $2.2 million portfolio and pay over 6 grand a month in dividend income, click the video on your screen to find out which one it is.